Well, thanks for tuning into this conversation. The IT numbers, the top 4 companies have come out with results. There are a few other mid caps which have come out too. And I think it's important to put into perspective, not just what's happening in the quarter, but what the trend ahead could look like. So for a quick conversation, Girish Pai of Nirmal Bank Securities Johnson right now is a veteran in the research space at large and IT in particular, and it will be important to have his thoughts. Girish, good having you. Thanks for joining in. Girish, I know that somewhere maybe a couple of years ago or 3 years ago, you had turned negative on IT. And I think about maybe a quarter or two ago, you turned positive on IT. Now, how is the thesis playing along? And has Q2 been more a vindication of the same? Or do you believe that some things still need to be done?
Neeraj, thanks for having me on the show. So yes, you're right. I've been negative on IT for quite a number of years. In fact, for the last 5-6 years, I've been negative on IT. Except for like a brief period in 2018 when I turned tactically bullish because of some related tax reform upside that I saw. The negative view was more because of the slower growth that I anticipated in the sector. So if you look at the last 5 years or even the last 3 years, the dollar revenue growth for the industry has been in the region of 6 to 8% on an organic basis. And if I look at Nifty 50 and if I look at the IT stocks in Nifty 50, except for TCS, which delivered a barely 10% earnings growth and a 10% kind of a revenue growth in INR terms, by the way, in the last 5 years between FY15 and FY20. And none of the other IT services firms actually delivered that kind of a growth. This in the context of, I think, somewhere close to 23, 24 companies in the Nifty as it's now delivering double-digit growth over the last 5 years. So it's been a bit of a challenge to recommend stocks where growth is a bit of an issue. So what is changing now and why I have turned relatively more bullish? I won't say I'm completely bullish as we speak. It's a very selective call. I've turned kind of a neutral because the run-up has been very steep. And the call is that there's going to be earnings acceleration, partly driven by a pickup in organic growth. So I believe now that we could potentially see 300, 400 basis point increase in organic growth for the industry. And there could also be some faster earnings growth coming through because of margin expansion. So I'm not counting on an INR depreciation driven kind of an earnings acceleration. It is more a margin expansion driven earnings acceleration. More depends on which company you discuss, but it's more gross margin driven than SG&A driven. There are obviously some companies which are going to be more SG&A driven margin expansion that one is doing. So why has the view changed? It is partly to do with the fact that there is a faster earnings growth that one is anticipating beyond FY21. I'm talking about FY21 to 23. And I think the other thing to look at is, IT in the context of what you have in the market. I think earnings of certain sectors, especially the financials and most of the lenders, are challenged because of what I would call asset quality issues kind of coming back to the fore. We kind of settled them. The previous asset quality cycle, we were on the verge of kind of settling that, but we now have a new asset quality cycle kind of coming up. So there's uncertainty of earnings there, and I would say that kind of also helped in terms of turning the tide in favor of IT.
Okay, one of the beliefs, Girish, I'm glad you mentioned the margins. We'll since you've mentioned that, we'll first talk about that, then I'll talk about some of the other factors. But if you look at quarter 1 and quarter 2, and then I hear a few fund managers talking about how the EBIT margin growth could lead to an eventual ROE uptake, which could lead to an eventual valuation multiple uptick in IT names over the course of the next 24 months. Would you buy that argument, or do you have a different point of view?
No, that is one of my core arguments. I think that you're going to see EBIT margin expansion for most of the players. The larger ones, I think EBIT margin expansion is going to come from gross margin shift upwards. So if you look at the last 5 years, we've seen EBIT margins kind of contract for most of the sector, for almost all players in the sector, broadly driven by by gross margin contraction. And this has been the EBIT margin contraction has been more so for select mid-cap companies. We'll get to that discussion on that. But I see gross margins improving a tad. I'm not talking about very significant gross margin expansion. It could be 100, 150 basis point gross margin expansion over the next 2-3 year time frame. Broadly driven by a few things. One is I think there's going to be an offshoring shift that is going to drive. I think work from home, in my opinion, is going to lead to talent costs not increasing at the same pace that was previously. I'm not talking about the the offshoring shift part. I think there is a talent pool expansion that I foresee in the industry, which I think will help in controlling talent costs. I think there is going to be a greater level of using platforms. I think there's going to be a greater level of using automation. So these are the things while I think some of this is going to be given back to clients in terms of benefits to them, but I think some of it will be retained. So I actually see the trajectory of margins changing over the next 2-3 year time frame. So it's not I'm not saying that we're going to get into a margin up move for many years. I think it's probably going to play out over the next 2-3 year time frame. We'll have to see after that how things kind of pan out. So that is going to be one of the key factors. On the mid-cap side, I think a lot of the margin expansion is going to come from SG&A contraction. So a Mindtree, in my opinion, is a particular case where you're going to see margin expansion coming purely from SG&A control.
Okay, interesting. Mindtree. I had a chat with the management, Girish. I don't know. I mean, after a quarter which didn't seem as good as maybe some of the other large cap peers, would you reckon that was a quarterly phenomenon and things will improve for them fundamentally as well, or would it largely be a margin story? Just a quick thought on Mindtree.
Neeraj, so Neeraj, my call on the sector is that last 3 to 5 years we've had a demand constrained environment where the story was more in terms of market share shift. So we were basically pushing these stronger plays, people who had more capabilities, where the business was going. There was a market share gain which was playing out in favor of, say, a TCS, an Infosys, and Accenture. I think we now entering a different kind of environment where I think demand is not going to be as constrained as it was over the past 5 years. It's going to be, as I call in the report I put out, it's going to be a rising tide lifting most boats kind of a situation. So I would think that a lot more companies are going to benefit from this. Some of the weaker players or some of the less capable companies, I would say, I would kind of rephrase that, not less capable, a fewer number of capabilities, so to speak, compared to a TCS. I think those would probably benefit, in my opinion. And I would think that some of the companies which you had margin issues in the past, I think some of that could be good. Specifically with respect to Mindtree, I think that's a very specific kind of a phenomenon. While explicitly LTI and Mindtree have not commented that they're working together, I feel that the SG&A contraction from about 20 to 22%, that is the typical SG&A as percentage of sales number that one has seen for Mindtree over the last, I would say, 4-5 years. That number coming off to say 16% in Q1 and then later to 14% in Q2, in my opinion, suggests that LTI and Mindtree are kind of working together. So the story of earnings expansion or the significant earnings expansion one has seen in Mindtree in the last couple of quarters has been broadly driven by SG&A compression, and I think that is because these two companies are working together, probably driven by pressure from the parent. So yes, Mindtree growth has disappointed a bit, but I would say that it is in a position to grow at high single-digit, low double-digit levels over the next couple of years, and I'm talking about beyond FY21. And combined with a higher margin that one is seeing, which will lead to better return on capital employed, I think there is a case for a multiple expansion, which is what's kind of played out in the last, I would say, 6 months or so.
Okay. Amongst the top tier names, Girish, and the 4 that have come out thus far, which one impressed you the most and why? And part 2 of my question would be, irrespective of the fundamental performance from a valuation and a stock return perspective, which one gives the biggest bang for the buck? Because I thought each of them had some individual levers going for them. what stands out for you? Which one of the top four stands out for you?
So I think all of them did fairly well. Maybe Wipro delivered just a 2% constant currency revenue growth on a sequential basis. But obviously, from a fundamental standpoint, that 4.8% constant currency growth that TCS delivered was outstanding. So the companies delivered. If I look at the financial numbers, they beat market expectations from a constant currency growth perspective. Margins were better, cash flows were better. A couple of companies came out with buybacks. The management commentary in the medium term was really positive. People are now talking about multi-year, growth pickup for them and for the industry. So I think a lot of the, I would say, boxes have been checked in some sense. What I would say near term is an issue for the industry is that 2H is not going to be that great, at least compared to 2Q. I think 3Q is going to be soft, and I think so would 4Q be. Seasonally, these are soft quarters. And more importantly, unlike in the past, we're going to see salary hikes come through. This was not something that was anticipated by the street, not something anticipated by the companies themselves. So typically, salary hikes would happen in 1Q and 2Q, and the margin hits would happen at that, in those quarters. Now you will probably see a situation at 2H where growth is slightly weak and the salary hits are going to come through. So there could be a bit of a challenge to traverse this 2H time frame for the companies, especially because they've run up so much. So that is obviously a bit of a near-term challenge. But if I look at, and you asked me the question about which companies I like, yes, from a standalone capability standpoint, TCS stands out. I think it's probably the best company out there and probably deserves the kind of valuation it is getting. On an absolute valuation perspective, it is the most valued IT services stock, even has a valuation even higher than that of Accenture and IBM. So that is deserved, at least so I would say. But having said that, from an upside standpoint, I think HCL Tech to me looks to be the best bet. So while I have an accumulate on most other stocks, I have a buy on HCL Tech, and I have a report I put out today talks about a 27% upside compared to the Friday's close. So there, I think HCL Tech, in my opinion, is going to be a disproportionate beneficiary of what I would call as the first phase of a digital move. So if you hear a TCS, you hear an Accenture, or even IBM, which kind of decided to split into two, they're all talking about a shift of infrastructure to the cloud, this whole infrastructure as a service kind of move. I think that could be something which could benefit HCL Tech in a pretty significant way, because I think that it's got the highest leverage out there. It's got the highest exposure in terms of revenue. My sense is that probably it's closer to 30%. And I think it's very well poised there. So I would say, and I don't think the multiples are that expensive. If I look at my FY22 earnings estimates, TCS is probably trading at somewhere close to 26 times. HCL Tech is probably closer to 17, 18 times. So there is a fair bit of expansion that's going to happen, possibility of expansion there. The other thing I like about HCL Tech is that this is something which is specific to me. I think the street is not like this very much. So HCL Tech has put a big bet on products. It spent about $3.1 billion in terms of investing in products. And the street is not liked it because they felt that this is value decretive, it's going to be value destructive. And they had ascribed a very large negative value to the products business, say 6-7 months back. While I agree that some of the products it bought from IBM are slow growing, there are parts of them which, in my opinion, are going to be significantly value accretive. We don't have the granular level data of some of these products, but some of them which are in the e-commerce space, or the collaboration space, the security space, cybersecurity space, I think these are going to be fairly fast growing in the kind of environment we are in post-pandemic. And these could be very significantly value accretive from here on, which I don't think the market is kind of taking cognizance of. So while I think TCS is the best company on a standalone basis from a capability perspective, I would, from a stock standpoint, I would bet on HCL Tech.
Got it. Girish, one final question, and that is on two companies which haven't come out with numbers as yet, but I'm just wondering if you, just give us the clarity of thought about these, because they're trying to, or one has tried to differentiate itself all these years as firstly being a products company of sorts, Persistent Systems. I don't know if you have some thoughts there. And two, with the recent IPO of Happiest Minds coming in, suddenly the focus wherein if this company comes on and say that, hey, everybody's trying to be digital in some fashion, the larger boys are doing that, we are already 96% digital. And for a layman, it's a bit confusing as to what is truly digital in a sector which is essentially focusing on being digital all the time. So can you tell us a bit about both of these? Quick thoughts on both.
Yeah, I do cover Persistent. I have looked at Happiest Minds, so I'll give my initial thoughts on Happiest Minds.
Sure.
Persistent Systems, I think what is happening there, this is a company which has been shifting its business model, focusing away from its traditional area of outsourced software product development, where it was working with a lot of independent software vendors. It is now trying to shift towards the normal business IT services, which it had shunned many years back, and kind of trying to shift towards that. It's not done a great job thus far, but I think the last, I would say, 9 to 12 months under a new management, I think they've started executing well. And the sense I have is that the new management, in my opinion, is trying to build this business in a slightly different way, unlike in the past. And I'm at least whatever I'm hearing from Sandeep Kalra, who is the potential CEO candidate, in my opinion, is quite positive in the sense that he's trying to build out newer services which Persistent lacked in the past. So the typical model that Indian IT services firms have had is you enter a client and through a particular vertical, through a particular horizontal, and then you try to sell more and more services to them.
Not too many of them.
Oops. Okay. I think the earlier frame was all right. We'll just try and get this sorted. Just the final piece of that conversation left with Girish. Yeah, Girish, sorry, please finish your point.
I think there is a bit of a... Hello, can you hear me?
Loud and clear, Girish.
So I, just one sec, I think there's a bit of a challenge here.
No, but this is fine, Girish. Please continue. Please finish your point. We can hear you.
So let me just finish this. As I said, I think Persistent, the issue has been of not having too many things to sell to a client. I think what they've done now is you have a CEO, a potential CEO, who's probably going to kind of come in and start executing on increasing the breadth of its service offerings. I would say that is going to be positive in my opinion. But having said that, the stock run up has been very substantial. So I'll revisit the rating on the stock post the earnings numbers. On Happiest Minds, I'm a little skeptical on this whole theory about it being like 97, 98% digital. I would say that if I look at that company and the kind of growth it has seen the last couple of years, we're not even going back into history. So last couple of years, it's been reasonably strong growth. But on such a small top line, I don't think the numbers are really that great, because we've had companies at much larger top lines delivering 20-30% growth in their digital businesses. So while a lot of companies have stopped declaring digital numbers, so if you look at even an Infosys, for instance, digital last quarter, they delivered 25% growth on a much larger revenue base. So to that extent, I would say that to me, I would be very skeptical on a Happiest Minds being given the kind of multiple it's being given by the street. I do not think it deserves those kind of multiples. So broadly, that's where I would kind of lay my thoughts on that particular company.
All right, Girish, lovely talking to you today. Thank you so much for giving us a lowdown of how the space looks like post the numbers. Great having your thoughts.
I can't hear you. I have a bit of
I was thanking you, Girish. Nevertheless, I was thanking you. Thank you for joining in. And viewers, thanks for tuning into this conversation. Hope it helped you. Girish believes that in the large cap space, it's HCL Technologies, and within the mid cap space, Mindtree might have an expansion of margins, and maybe that might lead to an expansion of earnings as well. Do watch out for that one. Thanks for tuning in today.